I'm Michael Waldron, Director of Portfolio Management at Heritage Financial Services. Thank you for watching our presentation of the real deal economy. When I started in the wealth management industry, it struck me how many clients were interested in discussing the economy when reviewing their portfolio. Discussions with clients often center around economic cycles, recession risk, and economic measures such as unemployment and inflation. But from my training, finance and economics are separate fields. While what's happening in the economy may inform your approach to investing, knowing current or forecasting future economic figures in no way provides a crystal ball for how to invest a portfolio. The economic data may be pointing in one direction, but from an investment standpoint, the insight is completely upside down. Let's pretend for a second that you have an accurate crystal ball on the economy. At the beginning of the year, you know the US economy will post a change in GDP of negative 2%, a bad recession. Unemployment will increase by 2.6%, just slightly under its level today. And the ending unemployment rate will settle at 9.9%, clearly too high. With this perfect foresight, how would you position your portfolio? What would you expect the stock market's return and the bond market's return to be? In that year, stocks gained 23%, and bonds produced a 6% nominal return. Prices deflated, down 1/3%, making those extremely attractive real returns. The key is, what is already included in price? Let's dig into the economic data dominating headlines today, focusing on the Federal Reserve's monetary policy, inflation, jobs data, and recession risk. In 2022, the simple story was that the Federal Reserve increased interest rates, which drove down the price of stocks and bonds. That's not the complete story. If you look at the Fed rate hikes start in the early spring of 2022, the stock market had already fallen significantly before the first increase in the federal funds target. Over the first half of the rate hiking cycle, the stock market adjusted its expectations into prices. And while the fall and winter of 2022 and the beginning of 2023 saw the Fed continue to hike rates, returns in the stock market have been significantly positive. That is, the second half of the staircase, and arguably more, was already baked into prices in the early fall. There's been a paradoxical relationship between economic news and the stock market's reaction. Good economic results, which should be good for businesses, signals a continued need to tamp down inflation, which means more rate hikes, which leads to falling stock and bond prices. So the question becomes, when will inflation be under control and good news can be free to be good news again? Inflation is a rate of change. You don't need prices to come down for inflation to cease being an issue. All you need is for prices to stop going up aggressively. We saw the peak in year-over-year inflation in the summer of 2022. That rate of change has declined significantly. The year-ago prices to which we'll be comparing current prices, particularly energy prices and housing prices, are higher or similar. That is, goods inflation should stabilize. Part of ongoing inflation is the wage price spiral that occurs in the jobs market. Think about the jobs market like musical chairs. In a stable jobs market, the number of job openings, or open chairs, is very close to the number of people who are temporarily unemployed but willing and able to work, the people circling around the chairs as the music plays. Today, there's an imbalance between the number of open chairs and those circling around them, with more than 10 million job openings and only about 5 million people looking for jobs. When there's an imbalance like this, the economy needs to adjust. The Fed projects this gap to close in 2023. With unemployment increasing to 7.5 million, while job openings may drop down from about 10 million to maybe closer to that 7.5 million. This gap is important to watch as a signal that the tailwind behind inflation has stopped blowing and the Fed policy can switch to at least stop tightening. It's said that the Fed often raises rates until they break something. One way to measure if maybe something broke is to look at large movements in a generally stable market, here represented by the 2-year government bond yield. You can see what looks like a seismograph, showing events when something broke. 9/11 shows up. Lehman's collapse shows up. And after the first week of March, Silicon Valley Bank's failure shows up. There was a material shift in the Treasury yield curve from immediately before Silicon Valley Bank's failure to after it broke. Notably, the Treasury yield curve amended downwards its expectations for rate hikes in the first half of 2023 and started pricing in rate cuts this year. The orange points show future expected 1-month rates before the failure of Silicon Valley Bank, while the blue points show future expected 1-month rates after the failure of Silicon Valley Bank. For example, at the end of February, expectations were for short-term rates to exceed 5.25% at the end of June. At the end of March, these expectations for short-term rates were now to be below 5% at the end of June. The market clearly knocked off its expectations for much of the remaining rate hikes. 1 year from now, the expected short-term rate went from effectively equal to its current level to lower than its current level. The market is saying that it's expecting inflation to cease being the Fed's main concern and shifting to upholding full employment and spurring economic output growth. If we're probably going into a recession, run, right? Not so fast. Despite the economic news that seems to be pointing towards lower or negative output growth and higher unemployment, prices have adjusted. Our expected long-term returns in 2023 are much higher than at the start of 2022. Stock prices are already reasonable compared to companies' operating results. High-quality bonds are priced to deliver higher yields than average long-term inflation rates. There's a lot to be excited about in markets. Remember, the stock market may very well adjust its price before the economic numbers come in near their worst levels. And when some of the worst economic numbers are posted, it's perfectly possible that the stock market and the bond market produce good returns for investors. So, what's the real deal given the imbalance in the job market, moderating inflation, and recession risk? Bonds provide a much more attractive yield today than a year ago and are now acting as a diversifier to stocks in a portfolio. Their value as an asset class has increased. While rising inflation in the past year benefited real assets like real estate, we believe it's been priced in looking forward. Stock valuations in the US are historically normal. Foreign valuations are at healthy bargain levels. There's no reason to be afraid of a good allocation of stocks right now. A recession may lead investors to demand a higher rate of return on capital. So investors should make sure that the risk they're taking is reasonable and allows for an upward adjustment if prices create even better opportunities in the future. How should you be thinking about this as an investor? The best way to answer that is to share with you what the team at Heritage has been doing to make sure our clients are positioned well for what matters most right now. We reduced exposure to real assets and alternatives. We increased allocations to fixed income for conservative investment objectives, increased our allocation to fixed income and stocks in growth-oriented objectives, and lengthened the duration of our fixed income allocations to lock in higher yields for longer periods of time, and as the diversification benefit of fixed income has once again become an important element in portfolio management. Thank you for your time, and I hope you tune in next quarter as we dig into the economic data and sort out what to ignore to get to the real deal.